Welcome to this deep dive. If you've been watching the charts this week, I'm sure you already feel it, but I want to be really clear right up front. This is not a normal week in the markets.
No, it's really not.
It's a massive, just volatility-packed decision week. And our mission today, for everyone listening, is to basically cut through all the noise.
Yeah, because there is a ton of noise right now.
Exactly. I mean, we've got FOMC meetings, we've got major tech earnings, all this geopolitical tension, but we want to figure out exactly what the smart money is actually doing. We're looking for those price action anomalies, and we're going to give you the exact actionable levels you need to watch.
Right, because right now you really need those levels.
Okay, let's unpack this, because we are basically staring down a three-headed monster of headwinds right now.
A three-headed monster is a pretty accurate way to put it.
Yeah, I mean, first we've got a live Fed meeting. And when I say live, I mean the market is actively pricing in an actual hike.
Which is wild. Usually, they telegraph this stuff months in advance.
Right. And second, we have these massive earnings coming up from the absolute tech titans. We're talking Microsoft, Meta, Apple, Amazon.
It's a heavyweights.
And then third, you have all this volatile oil price action. I mean, there's this constant back and forth de-escalation in Iran, and crude oil futures are, they're trying to hold support right at that 82.84 level.
Yeah, 82.84.
Hmm.
And, when you have a week like this, your standard technical analysis, like just looking at chart patterns in a vacuum, it's completely overshadowed.
Oh, totally useless?
Pretty much. Macroeconomic realities completely take over, which is why we have to look at how institutional capital is actually repositioning itself.
So how is the market reacting to this three-headed monster? Because from what I'm seeing, they are aggressively rotating out of growth and just running towards safety.
Running is the right word.
Because it's a massive anomaly on the charts right now. The standard market drivers look horrific. I mean, you look at the QQQ, the NASDAQ UTF, and it has suffered this severe head and shoulders breakdown right below its neckline.
It's a very ugly chart.
Yeah. And then the SPY, the S&P 500, it looks like it's forming this massive distribution pattern, maybe a diamond top or even like a triple or quintuple top.
Yeah, and what's fascinating here is that the capital isn't just evaporating, right? It's hiding.
Right, it has to go somewhere.
Exactly. It's a massive flight to safety. And we're seeing this incredible outperformance in the defensive sectors. XLV, which is healthcare, is working perfectly. I mean, names like J&J are doing great.
Oh, wow. J&J.
Yeah. And then you've got XLF for financials, XLI for industrials, and XLU for utilities.
Utilities. I mean, the most boring stuff imaginable.
Right, but it's textbook perfection for a defensive rotation. Just look at the Dow Jones. It pulled back and held its daily 50-moving average with absolute algorithmic precision.
Just bounced right off it.
Exactly. It hit the 51,822 to 51,716 level and just held perfectly.
That is wild. It's almost like it's like a nervous driver, right?
Right.
They're speeding along in a sports car, which is like tech and semis, and they suddenly slam on the brakes and jump into a literal tank, like utilities.
That's a great way to visualize it.
But I have to ask, is this rotation just a temporary hedge for the week, or is this a sign of like deeper structural fear in the market?
Well, the way they're executing it with that mechanical precision on the moving averages suggests it's highly tactical right now. But it does show real fear regarding tech.
Which brings us to the tech megacaps. Because speaking of structural fears, there is this massive, just glaring anomaly in how the market is treating different tech companies right now.
Oh, absolutely. The divergence is huge.
It's entirely based on their spending habits. So you've got Microsoft, Meta, and Amazon, right? They are all ramping up massive capital expenditure to build out all this AI infrastructure.
Billions and billions of dollars.
Right. But then there's Apple. Apple is barely spending anything on capex right now.
Almost nothing compared to the others.
And the anomaly is that the market is actually rewarding Apple for doing nothing. I mean, Apple had one of its most bullish runs of the entire year on Friday.
It was incredible to watch.
While semiconductor names like ARM and QCM are just getting totally punished. Why is the market rewarding a tech company for not investing in the future?
Because in a high-rate, uncertain environment, negative free cash flow is suddenly a massive liability. Building AI data centers is insanely expensive.
So they're burning cash.
Right. And the market is punishing that cash burn. But Apple is hoarding its cash. So the market is trading Apple as the ultimate safe haven tech stock.
Here's where it gets really interesting. It's like, imagine a guy sitting at a high-stakes casino table.
Okay.
And everyone else, like Microsoft and Meta, they're going all in on AI. They're pushing all their chips into the middle of the table. But the Apple guy is just sitting there, arms crossed, refusing to place a bet.
Right. Just holding his chips.
Exactly. And somehow the guy just holding his chips is the one winning the night.
Yeah, that's exactly what's happening. And for our listeners, this creates a dream setup on the chart for Apple.
Okay, what's the level?
You want to look for an actionable pullback to the triple top high. That sits right around the 329 level.
329. Okay.
Yeah, and if it breaks through 335, the momentum is likely going to carry it straight to new all-time highs at 339.
Wow. So Apple is just defying gravity while tech drags the rest of the Nasdaq down,
Pretty much.
which means we really need to look at the exact technical battlefield on these indices. What actionable levels should we be watching?
Well, the divergence between the S&P 500 and the Nasdaq Q is stark. I mean, on Friday, the S&P actually made higher lows.
Despite all the panic.
Yes, but the Nasdaq Q completely broke Thursday's lows.
Ouch. So for the S&P 500, what are the actionable levels?
You need to watch the Friday highs. That's the 7496 to 7504 zone.
7496 to 7504.
Got it. If the S&P can hold above that as a higher low, it might actually push toward the daily 20 moving average. But if it fails there,
Then we get a drop.
yeah, gap fill all the way down to the 740 demand zone is highly likely.
Oh, man.
And you also need to note the crucial 7432 to 7443 support zone on the way down.
Okay, so that's the S&P. What about tech? What is the literal line in the sand for the QQQ and the NASDAQ?
For the QQQ, you are looking at a massive, highly critical triple, or really a quadruple bottom, on the daily chart. That's at 686 to 687.
That's a huge level.
It is. If they can't bounce from there and reclaim 696, the door to the downside is wide open. We'd be looking at a gap fill down to 682.77.
Yikes.
And meanwhile, NASDAQ Q futures are just aggressively rejecting the 28,700 to 28,740 level.
So what does this all mean for someone listening? Like, should a trader even bother trying to play these tight ranges right now?
Honestly, no. With FOMC and all these tech earnings looming, the highest probability is just a volatile chop fest.
A chop fest.
Yeah, just violent swings between these levels. Honestly, sitting on your hands is the smartest play you can make right now.
I mean, preserving capital is a position too, right?
Absolutely.
Okay, so if TradFi traditional finance is this choppy risk-off mess, my next thought is crypto. Does crypto offer an escape?
The short answer is no.
No.
Just flat out no.
Right, because the macro headwinds are suffocating digital assets too. Yeah, I've noticed Bitcoin and Ethereum are really struggling to break out. And I'm assuming that's because the US dollar is breaking higher.
Yes, the dollar is breaking out of a multi-year consolidation.
Which acts as a massive headwind. Plus, we have rising yields.
Exactly. And if we connect this to the bigger picture, we have to look at the commitment of traders, or COT data.
The smart money positioning.
Right, the commercials.
Mhm.
And right now, their positioning is a major headwind. They are heavily bearish on BTC.
Really?
Yes. And even worse, they have what might be a record net short position on ETH.
A record net short on Ethereum. Wow.
Yeah, and since they flipped bearish, ETH has basically been down only.
Down only. That explains why all these technical breakouts are just failing instantly. I mean, look at Bitcoin. It had that 4-hour inverted head and shoulders pattern.
A beautiful setup normally.
Right. But it completely failed and just got stopped out around the 64.8K to 65.2K area.
Yeah, in this macro environment, those patterns just become traps.
So are there any glimmers of hope? Any actionable levels we can actually trust?
Well, for ETH to even be viable, it needs to get above 2,000 on the daily chart, period.
Okay, 2,000.
But interestingly, some smaller altcoins actually look technically better.
Like what?
Algo and UNI. They've formed these nice descending, broadening wedges and inverted head and shoulders patterns holding above the cloud.
Oh, that's interesting. What about Solana?
Solana has some strength, but it really needs to reclaim 80 to sustain a rally.
Okay, so let me ask you this. With the AI cloud settings not even fully bullish on Bitcoin yet, and commercials heavily short, is the crypto play basically the same as the equities play? Like, do we just wait it out?
Yes, exactly. Historically, the real life-changing money is made when price is above the weekly cloud.
Not in the chop.
Right. You don't make it fighting a garbled mess of a 65K to 75K range on Bitcoin.
Yeah.
You just get chopped to pieces.
Yeah, death by 1,000 cuts. So just to bring this all together for you listening, across both equities and crypto, this entire week is completely dominated by macro uncertainty.
100%.
The smart money is rotating to defense. They are buying utilities and healthcare. They are heavily shorting Ethereum. And, crazy enough, they are rewarding companies like Apple that are just hoarding their cash instead of spending it.
Yeah. And the final lesson here, really, is that sometimes the best trade you can make is deciding not to trade at all.
Sit on the hands.
Exactly. Just wait until the major event risks, the FOMC, the tech earnings have passed,
Yay.
and the market finally chooses a definitive direction.
Let the dust settle.
Oh.
Well, I want to end with a final thought to leave you pondering. Because we talked about how the market is currently rewarding Apple for hoarding cash, right?
Mm.
And it's actively punishing the other tech giants for spending billions on AI infrastructure.
Right.
But what happens to all these charts when those massive AI investments either start generating unprecedented profits, or on the flip side, what happens if they fail to deliver entirely? I mean, when that day comes, the rotation is going to be absolutely historic. So definitely keep an eye on that. We will see you next time.